These are the financial details behind Tokyo Disney that reveal how one licensing agreement costs Disney hundreds of millions in profits every single year. While Disney collects roughly $315 million annually from Tokyo Disney Resort in Urayasu, Chiba Prefecture, the Oriental land company that actually owns and operates the parks keeps over $755 million in net profits for itself. Oriental Land Company, which trades on the Tokyo Stock Exchange under the ticker 4661.T and is majority owned by Keisei Electric Railway and Mitsui Fudosen, has created one of the most profitable licensing arrangements in business history. This is not just any theme park deal. Tokyo Disney Resort generates more revenue than all other Japanese theme parks combined, making it one of the most profitable Disney properties worldwide. Yet Disney does not own a single square foot of it. The story begins in 1974 when Disney was approached by the Oriental Land Company with an unusual proposition. Instead of Disney investing its own money to build internationally, OLC would finance, construct, and operate an entire Disney resort in Japan. Disney would simply license its intellectual property and collect royalties. At the time, Disney executives were skeptical that a Japanese audience would embrace American-style theme parks. They were catastrophically wrong. The licensing agreement signed in April 1979 by OLC President Masatomo Takahashi gave Disney just 5% of gross revenue from food and merchandise, 10% from admissions, and 10% from corporate sponsorships. Disney's total investment? A mere $2.5 million. Meanwhile, OLC borrowed $1.4 billion to build what would become Tokyo Disneyland. When Tokyo Disneyland opened on April 15, 1983, it shattered every expectation. The park attracted nearly 10 million visitors in its first year alone. By 1994, 149 million people had visited Tokyo Disneyland, which was more than Japan's entire population at the time. OLC paid off their massive construction debt in just 3 years, a financial feat that highlighted the extraordinary profitability they had secured. Today, the numbers tell a staggering story. In fiscal year 2025, Oriental Land Company reported sales of 679.3 billion yen, roughly $4.5 billion. Their net profit margins consistently outperform Disney's own parks. While Disney collects approximately 7% of total revenue as royalties, OLC keeps everything else, including all operational profits, real estate appreciation, and expansion revenues. Think about what Disney gave up. The Fantasy Springs expansion that opened at Tokyo Disney Sea in June 2024 cost $2.1 billion to construct. That's double what Disney spent on Star Wars Galaxy's Edge at both Disneyland and Disney World combined. This single expansion projects to generate 75 billion yen, about $500 million in additional annual revenue. Disney receives 7% of that as royalties. Oriental Land Company keeps the remaining $465 million in new revenue streams. The contrast becomes even starker when you examine Disney's other international ventures. When Disney built Euro Disney, now Disneyland Paris, they structured it as a joint venture to maximize profits. They would receive royalties plus management fees plus profit sharing, potentially earning over $1 billion annually if successful. With their more recent Shanghai Disney Resort, Disney learned from the Tokyo experience and negotiated a joint venture partnership with Shanghai Shendi Group, giving Disney 43% ownership. Hong Kong Disneyland also operates under a joint venture model where Disney maintains equity stakes. The difference? Euro Disney was a financial disaster for years, while Tokyo Disney became a money-printing machine from day one. Michael Eisner, who became Disney's CEO in 1984, reportedly recognized the Tokyo deal as a strategic error. By then, Tokyo Disneyland was already proving theme parks could be Disney's most profitable division. Eisner made international expansion a top priority, but the damage was done. Disney had locked themselves into a licensing-only relationship that would span decades. The agreement's longevity compounds Disney's missed opportunity. The current licensing deal extends through 2076, meaning this revenue stream will continue flowing to Oriental Land Company for potentially another 50 years. Over the past 4 decades since opening, conservative estimates suggest Disney has foregone $10 to $20 billion in cumulative profits by not owning Tokyo Disney outright. What makes this particularly frustrating for Disney is how well Oriental Land Company operates the parks under Chief Executive Officer Yumiko Takano's leadership. Industry observers consistently rank Tokyo Disney's service quality, maintenance standards, and guest experience above Disney's American properties. Oriental Land Company invests heavily in new attractions, and it maintains the parks to standards that often exceed Disney's own facilities. They have essentially become better at being Disney than Disney itself. This superiority creates an additional strategic problem. Because Oriental Land Company maintains full operational control, they make decisions about content and attractions independent of Disney's corporate policies. While Disney has spent years removing or modifying attractions deemed culturally insensitive, Tokyo Disney Resort operates essentially frozen in time. Splash Mountain, based on the controversial Song of the South film, continues operating in Tokyo while Disney converted the American versions to Tiana's Bayou Adventure. Oriental Land Company makes these decisions based on Japanese cultural sensitivities and profit considerations, not American corporate policies. The financial disparity becomes more striking when examined against Disney's overall performance. Disney Experiences, which includes all Disney parks and resorts, generated $34.1 billion in revenue for fiscal 2024, with $9.3 billion in operating income. Tokyo Disney Resort alone accounts for roughly 13% of total Disney park system revenue. But Disney receives only a fraction of the profits generated by what many consider their highest quality resort. Oriental Land Company's aggressive expansion plans highlight how much Disney is missing. Their long-term strategy extends to 2035, with goals of exceeding 1 trillion yen in annual sales. They are diversifying into cruise operations, with a Disney-branded ship launching in 2029 that will generate additional royalties for Disney, but substantial operational profits for OLC. Every expansion represents millions in construction contracts, ongoing revenue, and profit margins that flow to Oriental Land Company, rather than Disney shareholders. The mathematics of the missed opportunity are sobering. In fiscal year 2025, Oriental Land Company's revenue of $4.5 billion generated an estimated $755 million in net profits. Disney's 7% royalty yielded approximately $315 million. If Disney owned Tokyo Disney Resort outright, like Walt Disney World, it would keep the entire $755 million in annual profits, plus benefit from real estate appreciation, and have complete operational control over one of the world's most successful theme park destinations. The irony extends beyond pure financials. Disney has struggled with attendance and satisfaction issues at its American parks, implementing controversial policies like paid fast passes and reducing maintenance standards to increase profit margins. Meanwhile, Oriental Land Company operates Tokyo Disney with the guest experience standards and investment levels that built Disney's reputation. They have maintained the Disney magic that Disney itself sometimes struggles to deliver. Recent attendance figures underscore Tokyo Disney's success. In 2024, Tokyo Disneyland hosted 15.1 million visitors, ranking as the 4th most visited theme park globally and the 2nd in Asia. The resort's 2 parks combined welcomed 27.56 million guests, with average spending per visitor reaching a record high of $111. These numbers represent not just successful operations, but massive profit margins flowing to Oriental Land Company. Industry analysts describe the Tokyo Disney licensing agreement as Disney's greatest strategic mistake. The company traded away ownership of what became their most profitable international property for a low-risk revenue stream that seemed sensible in 1979, but looks catastrophically short-sighted today. Every quarterly earnings report from Oriental Land Company serves as a reminder of the billions Disney left on the table. Oriental Land Company's success has created a unique situation in the theme park industry. They operate under Disney's brand while maintaining independence that allows them to outperform Disney's own properties. They have proven that the Disney formula works spectacularly when properly executed, and that irony highlights areas where Disney's parks fall short. As Disney continues reporting strong but not spectacular performance from their owned properties, Tokyo Disney Resort consistently delivers record-breaking financial results, under Oriental Land Company's management. The licensing royalties Disney receives represent a fraction of what they could have earned through ownership, making Tokyo Disney simultaneously Disney's most successful international venture and their most expensive strategic oversight. This licensing agreement stands as a monument to how a seemingly conservative business decision can cost billions over time. While Disney minimized their risk in 1979, they also minimized their reward from what became one of the most successful theme park operations in history.